Over the weekend, I came across a video of Mr. Sankaran Naren that I found very honest and insightful, but at the same time scary for investors in 2025. He basically gave a speech on 20th January at one of the big mutual fund distributors gathering and highlighted some important concerns where he said that 2025 is the most dangerous year after 2007. Now we all know that 2007 was the year that witnessed one of the biggest global meltdown after the dot-com bust where the Nifty index tanked more than 50%. Yes, the entire index of Nifty 50 tanked more than 50%. So you can imagine how brutal the correction would have been at individual stock level and mid-cap and small-cap level. But why is Mr. Sankaran Naren comparing 2025 with 2007? What is the risk he is worried about? Hey everyone, my name is Sahil and this is my Personal Finance Academy. In today's video, I want to discuss the key risk highlighted by Mr. Sankaran Naren that have made him worried for the Indian investor in 2025. Here, please note that my intention behind this video is not to create panic. My intention is to create awareness. We all know that there's a sharp correction going on in the Indian stock market and many individual stocks are already down 30 to 40%. So I'll first discuss the key risk highlighted by Mr. Sankaran Naren and then I'll help you figure out how to mitigate some of this risk from stock market in 2025. Alright, let's get started. Okay, before we proceed, let's first understand who is Sankaran Naren. So he is the Chief Investment Officer of ICICI Prudential Mutual Fund, one of India's largest mutual fund company that manages total AUM of around 9 lakh crore rupees as of December 24. Mr. Sankaran Naren has done his bachelor's from IIT Madras and master's from IIM Calcutta. Today, he has 35 years of experience in the market and he is known for his contrarian investment approach. So with the kind of reputation Mr. Sankaran Naren has, obviously, if he is raising some key risk and comparing 2025 with 2007, it is worth listening. Now coming to his speech, he highlighted some important points. His first point is on SIP related risk. Over the last few years, we have witnessed a massive amount of money inflow into the Indian equity market via SIP. And we all say that SIP is a great way to invest in stock market where you capture both highs and lows and generate a decent return in the long run. However, the risk happens when you do SIP in the wrong products at the wrong time. He said that if you had done a SIP investment between 95 and 2002 for 7 years in India, the return would have been 0 or negative. If you had done a SIP investment in mid-cap between 95 and 2002, the returns would be a big negative. If you had done SIP investment between 94 and 2002, it would have been even more negative. If you had done a SIP investment in mid-cap between 2006 and 13, the returns would have been negative. So here the time duration is very important. If someone is doing an SIP for 20 years, then there is no problem. But the problem is very few people would end up doing the SIP for 20 years. He gave a great example of his own fund, which is ICICI Value Discovery Fund. And it has generated amazing return in last 20 years. But are there investors who did SIP for 20 years in this Value Discovery Fund? Well, he's yet to find out. Maybe 1 or 2 people. Although here I think 20 years ago there was almost zero awareness about mutual funds and all. And today there is very high awareness. So it won't be fair to find people with SIP in last 20 years. I'm sure there will be many people today who would continue their SIP for the next 20 years. But the point is, SIP is to be done for long term. But majority of people make the mistake of doing SIP when market is at the peak of the bull run. On top of that, the biggest mistake they make is they chase the return. So during 2020-21, there were hardly few people doing SIP in mid and small cap. And today, majority of people are doing SIP only in mid and small cap. They have completely ignored the large cap category. In fact, I was also going through one of the report that highlighted that the 12-month summary of money flow as of 30th November, where 38% of net inflow of money was in sectoral or thematic funds. That's outright crazy. Mid-cap witnessed 9% inflow and small cap 10% net flow. Interestingly, large cap that represents 66% of India's listed free float market cap has got only 12% of AUM breakup. Mid-cap that represents 16% of market cap enjoys more AUM than large cap. Even small cap has similar AUM of large cap. And highest AUM is in thematic funds. Clearly, Indian investors are chasing return by investing in thematic funds, mid-cap and small cap. Here, please note that there's nothing wrong in having exposure in mid-cap, small cap, or for that matter thematic or sectoral funds if you have that risk appetite. But the key problem is majority of people have ended up investing their money at the peak of the valuation because they simply chased return. And that is one big risk highlighted by Mr. Sankaran Naren. Nifty small cap 250p touched a peak of 35 and it was at levels of 32.9 on 28 January. There's already a very good correction and PE has now fallen to levels of 30, but it is still on the higher side. Now, of course, it is not that every stock in mid cap and small cap is expensive. You will definitely find opportunities, but the point is, at broader level, the valuations became expensive, and when you deploy the money in a mutual fund, the fund manager would have to deploy the money in the stocks within his mutual fund no matter how expensive they are. So the key here is not to chase the returns. Always stick with right asset allocation. Have a fine balance across large, mid and small cap. We have been discussing this for a long time now. In fact, I did a video last month only on how to navigate the volatility in stock market, and asset allocation was one of the most important factor. Having mentioned all these kind of risk of high valuation and people chasing return, he also highlighted the brighter picture. He said that the brighter picture is macros. India is in a great shape in terms of macro. There's zero problem in Indian macro. Be it banks balance sheet, corporates balance sheet, government focus on macro in terms of household saving at top of the pyramid and so on. The only problem is valuation, and that too specifically in mid cap and small cap. Again, he clarified that if your plan is to do SIP for 20 years, the returns would be good. But at current levels, if you average at high valuation, there's high probability of bad return in the near to mid term. So you have to be very clear with that, particularly for SIPs that started after 2023. Personally, if you ask me, I would agree to what Mr. Sankaran Naren has said. But does that mean you should stop investing? Definitely no. If you have invested in mutual funds via SIP, I would suggest keep investing for the long term. But at the same time, take a step back and reassess your individual asset allocation. If it is too much into mid and small cap, it's worth considering a good exposure in large cap. So this is for mutual fund investors. If you have invested in individual stocks, you need to reassess your investments on a case-by-case basis based on your risk appetite and investment horizon. Personally, I also have high exposure in mid and small cap, but I also have decent exposure in large cap. Plus, my risk appetite is high and I have all the patience for long-term investment. For me, it's not a 2-3 years of game. I'm here for next 20 years. And I've always been prepared to take that 20, 30, 40% hit in my portfolio because I know that it's part of the journey. That said, I'm closely observing the market trends, including the quarterly results that I discuss in my weekly video series that also include my own investment strategies. I'm 100% certain that we would eventually reach a point where valuations would become very attractive in selected mid and small cap stock, and I would be happy to accumulate them for long term. There's already a good correction, and if this weakness persists for next few months, then valuations would become even better to add selective stocks. Yes, it's not easy to watch your portfolio going down, but corrections always create opportunity for long-term investors. Only thing you need is patience and conviction. But to build patience and conviction, you need a good knowledge of the market condition, valuation, and future growth prospect of both company and the economy. Okay, let me not stress this video further. In case you want to watch the speech of Mr. Sankaran Naren, I will provide the link in the pinned comment. Now tell me in the comments, what do you think about market valuation? Is it still expensive? And are you utilizing this correction to invest or waiting for more correction? Let me know in the comments. I'll see you in the next video. Till then, take care.